The Fed just held rates, and this isn't just about interest rates. This is a power struggle between Powell and the White House. Powell wants to keep rates high to fight inflation. The government wants cheap money to boost the economy, and let's be honest, to handle the debt. And now they're going at it in public, while you're out here wondering why your credit card APR is 29% and mortgage rates won't come down. So yeah, this matters a lot. In this video, I'm going to show you what the Fed just did, why there's pressure to cut, why houses are becoming cheaper, and what you can actually do to make money in the middle of all this mess. Let's get into it. Just don't forget to subscribe and be part of our community of cousins. So first, what actually happened? The Fed held the benchmark rate at 4.25 to 4.50%. That was expected. Inflation data looks better. CPI is sitting at 2.4% year over year. PCE is trending near target, and even wage growth has cooled. That's good, but not great, especially when you factor in new tariffs on imports, which push prices up, and geopolitical pressure that's adding volatility to oil. And then there's the labor market, not falling off a cliff, but clearly softening. Jobless claims are up. Continuing claims just hit 1.95 million, the highest since 2021. So Powell's thinking is simple. Stay put. Don't hike, don't cut, just hold. But that hold has real consequences. Borrowing stays expensive, capital stays tight, credit doesn't flow like it used to, and all that translates to pressure for you, for businesses, for asset prices. And yet, the move also sends a message. The Fed won't move until the data forces their hand. Not politics, not pressure, just numbers. Why does Trump want the Fed to cut rates? Because rate cuts make the economy look strong. When the Fed cuts, credit gets cheaper, the stock market goes up, real estate picks up, and consumers start spending again. Trump knows this. He used it when he was president. He pressured the Fed multiple times to cut rates, even when the economy was growing, because he understood that cheaper money keeps the markets hot. But now there's another factor. U.S. debt has exploded. The government is paying over $1 trillion a year just in interest. That's more than it spends on defense or healthcare. Rate cuts don't just stimulate the economy, they give the government breathing room. Lower interest means lower debt costs, more fiscal space, and a happier market. So when Trump talks about saving the economy, what he really wants is cheaper money, because when rates drop, growth feels real again. Well, now that you understood the whole situation, that brings us to housing, because here's where things get interesting. Most people think that if the Fed isn't cutting, the housing market stays hot, that prices won't drop, that affordability won't improve. But what's actually happening right now, quietly, is the beginning of a correction, not a crash, a correction, and it's already started. Redfin just reported that in April 2025, there were over 500,000 more listings than buyers, the largest inventory gap since 2013. That alone tells you sellers are struggling. Case-Shiller data shows that in March, home prices in the 20 biggest U.S. metros dropped by 0.12%, the first monthly decline in over 2 years. That might sound like a small number, but it's not about the percentage. It's about direction, it's about momentum, and that momentum is turning downward. Zillow confirms it. Nationwide, home prices are only up 0.7% year over year. Compare that to 4.4% the year before, and it's clear price growth is collapsing. And in many cities, it's already gone negative. Austin, Tampa, Phoenix, Dallas, down 2 to 5% depending on the neighborhood. These were the COVID boom winners. Now, they're holding the bag. And this is where the opportunity hides, because while everyone's waiting for the Fed to cut, the real action is happening in the price of the asset. Sellers are blinking first, homes are sitting longer, builders are offering incentives, and if you're watching closely, you can already feel the shift. But here's the part no one explains: the disconnect between the Fed rate and your mortgage rate. Most people assume that if Powell holds or cuts rates, their mortgage should get cheaper. But that's not how it works. The Fed controls the short-term overnight rate between banks, not directly the long-term mortgage market. Mortgages, especially 30-year fixed ones, are more closely tied to the 30-year Treasury yield, and right now the 30-year is still elevated, hovering around 4.6% to 4.8%, because markets don't fully trust that inflation is dead. They're still nervous. They're watching tariff risks, energy prices, potential stimulus, and political interference. So even though the Fed held rates, mortgage lenders are still pricing in long-term uncertainty. That's why your 30-year fixed is still near 7%. It's not about what Powell just did. It's about what the bond market believes he might be forced to do in the months ahead. And once you understand that, you can stop waiting for the Fed and start paying attention to the bond market, because when confidence starts to come back, when inflation expectations fall and yields start to soften, mortgage rates can start dropping even before the Fed moves. And that's where the opportunity is. And what should you do? Well, but I don't want to talk now with the guys looking for a family house and why. I recently recorded a video explaining how I bought my $1 million house and how you should do it to take advantage of the opportunity that the rich have been taking advantage of for years. Today's video is for you who have no money and no prospects of owning a house anytime soon. I want to take you by the hand and guide you to an opportunity that can help you save money for that house and much more in the future. And look, I'm a big fan of diversification. Personally, my portfolio includes stocks and companies, Bitcoin, bonds, and also real estate. And I buy both houses and real estate paper assets. And before I had the money to to start buying houses, land, things that appreciate, I had to settle just for paper assets like REITs, which guaranteed that I would be exposed to this market without the same high value, without the same risks, without the difficulties of operating in this market by diving headfirst, because it is very complex and I can only do it today because I have, in addition to a lot of money, the support of a team. So let's talk about REITs. REITs are in the gutter right now, and that might be exactly why it's time to buy them. They've underperformed the S&P 500 for 2 years straight. The headlines scream commercial real estate crisis, and everyone's still allergic to anything with the word office in it. But here's what most people miss. Public REITs already took the hit. While private real estate funds are just starting to adjust to new interest rate realities, REITs have been repricing since 2022. In other words, they're early cycle again, and that's where the upside lies. According to Forbes, this is the exact moment in the cycle where REITs tend to bounce right before rate cuts begin, and the data backs it up. In 6 of the last 7 rate-cutting cycles, REITs outperform stocks. Why? Because falling rates do 2 things. They lower financing costs for REITs. They push yield-hungry investors out of bonds and into dividend-paying stocks. And REITs, they're basically income machines. By law, they have to distribute at least 90% of their taxable income back to shareholders. So when prices fall and dividends stay up, you're locking in 4%, 5%, even 6% yields backed by real assets. That's not speculation. That's cash flow. And it gets better. Insider buying is surging across several REITs, a signal that management believes shares are undervalued. Sure, office space is still a mess, but you're not buying real estate in general. You're buying specific sectors: logistics, residential, data centers, healthcare, stuff that's still producing, still growing, still essential. Want an example? Look at DLR, a data center REIT. Simply, Wall Street says it's trading 30% below fair value. Analysts, 15 buys, average price target of $189. Some even see it hitting $220. The fundamentals are solid, strong revenue, strategic leasing, and they're riding the AI and cloud wave hard. This isn't just a rat, it's an infrastructure play for the future. Yes, there's FX risk and valuation pressure, but for a data center giant trading at a discount, it might be the smart money's next move. Do you understand what I mean? This is far from being a recommendation. Don't do what I say just because I say it, but I wanted to show you that there are probably great opportunities that you may be missing out on in this market. And there's another 3 key points here. REITs have outperformed stocks on 20 to 50-year horizons. Most REITs are less volatile than the S&P 500, with some only half as volatile as the market at large. Several individual REITs delivered significantly higher returns than the S&P 500 over the past 10 to 30-year periods. So here's the deal. They're undervalued now. They're historically primed to outperform right when the Fed pivots. And they're offering cash flow today while you wait for capital gains tomorrow. You don't get many chances like this, and when the rebound starts, it usually moves fast. So if you're sitting on the sidelines thinking, I'll buy a house someday when I have the money, this is your first move. Start building exposure, start collecting income, start learning how this game works, with real money on the table at your scale, because when the next wave of capital comes rushing in, you'll already be in position. And that's how wealth is built, not by chasing headlines, but by moving early before the world figures it out.